Hey everybody, this is Mitchell Shields. I'm speaking to you here at Jeff Cait's Math.Logic.Wealth class. Earlier in the year, Jeff asked me to speak on the taxation of life insurance, and we worked through the PPI tax guide for life insurance, which is a great book. And today, as we enter into the conversation around sweeteners around life insurance, Jeff asked me if I could speak again on corporate ownership, and he asked me to keep it tight to 5 minutes. So I have the timer in front of me, and I'm going to do my absolute best. So we're going to talk through the 5 top things that we feel that advisors will need to know about corporate ownership in order to confidently sell more corporate ownership life insurance. Mindful of the fact this is not a tax course, and I'm not going to be getting deep into the nuances, as many of you are aware that I like to do. So really, as an introduction, life insurance is already a great planning tool, regardless of the sweetener that is owning it within the corporation. But I really want to talk about that corporate ownership and how that can further benefit your business owner clients, and the 5 key things that every insurance advisor should know about that ownership. So right off the bat, first thing, and I think this is kind of the table stakes one and the biggest layup for corporate ownership, is the after-tax cost advantage. Owning a life insurance policy in a corporation for a shareholder of that corporation is a completely legitimate planning tool from a tax perspective. And the biggest benefit right off the bat is that you're going to get a far better after-tax cost. As most business owners know, whatever we can pay through our corporation, we like to pay through our corporation. You're benefiting from those lower active business income tax rates. So we're assuming it's going to be active business in this corporation, and you're earning income at that 12 to 13% tax rate. And when you compare that to taking out money to fund things personally, and of course, we're using 50%, which may or may not always be a great rate to use when you're thinking about the marginal rate system, but just to keep things nice and clean, if you're assuming that somebody is going to take money out of their corporation and it's going to cost them 50% tax to do that, to pay the life insurance, that same $10,000 a year premium that the business owner might want to pay into life insurance could cost them $20,000 roughly on a personal side to do the extraction out of the corporation, where they could have it within the corporation for closer to that $11,000 to $12,000. So ultimately, this is a big win for the corporate owner, because they're able to use far less of their earned corporate dollars to fund this life insurance commitment that they're deciding to make. So I'd say that's number one that everyone should be aware of. The second one, and this gets thrown around a lot, I think, is this capital dividend account. And this is another big benefit, because you may think, well, Mitchell, if the life insurance is in the corporation, now we got to get it out, and it's going to be taxed at 50%. And the CRA and the government finance has a mechanism called the Capital Dividend Account, where essentially the full death benefit minus whatever the cost basis at the time is added to this capital dividend account, and that can be taken out of that corporation now on a tax-free basis. This also provides powerful estate planning tools. I note there the 164(6) carryback, where we can create a capital loss and carry it back against the capital gains at death. But this is not the tax course, so I'm not going to spend much time there. But having control and knowledge over what CDA will be available at the time, it can be a great benefit to those practitioners who are going to provide that planning support. Third one is estate equalization and buy-sell funding. So, a corporate life insurance policy, and this could even be the same corporate life insurance policy, whether it's, term at first or permanent or however you end up structuring this, it can be a great tool used to fund shareholder buy-sell agreements, right? If you have multiple shareholders, one of them passes away, and you want your holdco or whatever corporation to be able to buy out that other shareholder, having those funds come into the corporation can be, a great purpose. Key person coverage, maybe you have somebody in the corporation, or maybe it's yourself that you would need funds to replace. Or perhaps it's estate equalization strategies. I posed one example there. Maybe you have 2 children and one of them is going to inherit the business, and the business is the biggest asset, and you want to be able to make things, more fair to the other child. I think fair and equal is an interesting conversation we can have in this case, but I'm not going to dwell there. And when we're thinking about things like the buy-sell agreement, and I've spoken on this with Jeff in the group before, make sure you're reading the buy-sell agreement and that it aligns with that shareholder agreement ultimately. 4, there is a sheltering benefit to these policies. Policy cash value or accumulated value can grow on a tax-deferred basis. There's some tax nuance there, but for the most part, you're not going to be paying income taxes on any of the earnings you earn in that life insurance policy. It also can reduce your passive income exposure if you're worried about grinding down against that active business rate for companies that have a lot of retained earnings. And it is an efficient tool to borrow against, whether corporately or personally. But I always caution, and Jeff knows this and the group knows this, I always caution against planning to use this policy as a borrowing vehicle. It's a hard thing to promise 20, 30, 40 years out in the future that will be available. But it can be a nice sticky asset that lenders like to borrow against, or you can borrow directly from the policy with some tax considerations. And 5, and the thing I harp on a lot is make sure that it's owned by the right corporation. Moving a corporate life insurance policy out of a corporation later, if shareholders change, there's the corporation goes away or whatever the case may be, you're trying to sell the business, it can cause a lot of complication to move that policy and take some advanced planning. So use a long-term entity. When you can, put it in the holdco, stable opco that you're not going to be, you're not going to be selling. Think, potentially doctors, family doctors would be a good example of maybe an operating company where this might make sense. And you have to plan assuming that corporation is going to exist forever, and avoid using any entities that might be sold or restructured soon. So I think the 5 things, and I know I went a minute over, is the big things are corporate ownership makes the policy cheaper for our clients, and that's a big win for them. CDA provides a mechanism to still benefit from the tax-free nature of that policy. The life insurance can support a variety of goals, and that same policy can adapt to the ever-changing needs of that corporation and the family. There is a tax-deferred benefit within the corporation, but I always caution compare to what. We need to compare it properly based on risk and based on the allocation that the client is looking to make. And make sure you're choosing the right corporation for the long term. And a note that I didn't make there is also make sure that you align your ownership, your beneficiary, and your payer correctly to make sure you don't have any tax concerns as well, which we covered in the tax course. And corporate ownership isn't always the answer, but when it's right, it can be a very powerful suite.